Insurance-linked securities. Can you really invest in catastrophes? What if the next big investment opportunity wasn't in stocks, bonds, or real estate, but in hurricanes, earthquakes, and wildfires? Stay with me until the end, because today we're diving into one of the most mysterious, misunderstood, and shocking corners of modern finance: insurance-linked securities. These are assets that allow investors to put their money on the line against natural disasters. It might just be the most profitable yet riskiest bet you could ever make. The unlikely marriage of disaster and finance. When you think of investing, you picture Wall Street tickers, corporate earnings, and booming startups. But what if I told you there's an entire industry where investors are betting on storms, quakes, and catastrophes? This is not a movie plot. This is real. And it's called insurance-linked securities, a market where financial products are tied directly to insurance risks. In plain words, investors earn returns if disasters don't happen and lose money if they do. Sounds crazy? Maybe. But it's also a trillion-dollar idea in the making. Because behind every storm, every wildfire, every flood, there's an insurance company trying to spread risk. And in today's world of escalating climate threats, those risks have become too big for insurers to handle alone. That's where Wall Street and you come in. For the first time in history, ordinary investors can step into the shoes of insurers and profit from catastrophe if they dare. What exactly are insurance-linked securities? To understand this strange world, imagine this. A hurricane is forecast to potentially hit Florida. Insurance companies face billions in possible claims if the worst happens, but they don't want to hold all that risk themselves. So they turn to investors. Through an instrument called a catastrophe bond, the most famous type of insurance-linked security, they transfer some of that risk into financial markets. Investors buy the bond, and in return, they earn juicy interest payments far higher than government or corporate bonds. But here's the suspense. If the hurricane does strike with full force, the bondholders lose part or even all of their principal, because that money goes directly to cover insurance claims. In other words, investors are literally betting against disasters. If nature stays calm, they profit. If catastrophe strikes, they pay. This is not theory. This is happening right now, with billions in catastrophe bonds issued every single year. The birth of a strange market. The idea of insurance-linked securities first emerged in the 1990s after Hurricane Andrew devastated Florida and caused losses so massive that traditional insurers couldn't handle them. The solution was bold: spread the risk into global capital markets. Wall Street loved the idea. After all, natural disasters are largely uncorrelated with stock or bond markets. A stock crash in New York doesn't cause an earthquake in Japan. For investors seeking diversification, catastrophe bonds seem like the ultimate hedge. Today, this market has grown into tens of billions of dollars, and while still considered niche, it is increasingly being eyed by pension funds, hedge funds, and even retail investors through specialized platforms. The more unpredictable our climate becomes, the bigger this market grows, because every disaster means more risk to spread and more opportunity for investors willing to stomach it. How do you actually invest in catastrophes? Let's make this concrete. Imagine you right now wanted to invest in this market. How would it work? You would likely buy into a catastrophe bond fund managed by experts who understand the modeling of risks like hurricanes or earthquakes. These funds pay you returns as long as the specified disaster event doesn't occur. For example, a cat bond might be tied to an earthquake in California. If no quake above a certain magnitude happens during the bond's term, investors get their high interest plus principal back. But if a quake does happen, if the earth shakes, buildings fall, and insurance claims soar, the bondholder's money is diverted to pay for the recovery. It is investing at the edge of nature itself. You're not just trading numbers, you're trading on the fate of people, cities, and lives. The allure: why investors are drawn in. So why would anyone risk their money on disasters? The answer is simple: returns. Catastrophe bonds often offer yields of 6%, 8%, or even double digits, far higher than many traditional bonds. For big institutional investors, it's a way to earn outsized profits on risks that are tied to stock markets or interest rates. Even more, in years without major disasters, these returns look unbeatable. Many hedge funds and pension funds have quietly poured billions into this asset class for exactly this reason. And here's where the suspense builds. The longer the world avoids a mega disaster, the more seductive the returns look, until the day catastrophe strikes. The risks: betting against Mother Nature. Well, let's not sugarcoat it. This is not an investment for the faint-hearted. When catastrophe hits, losses can be catastrophic too. Investors can lose large portions, or all, of their principal in a single event. A hurricane, an earthquake, or a wildfire can wipe out years of returns in one night. And unlike corporate bankruptcies or government defaults, these risks are not financial in nature. They are natural, which means they cannot be fully predicted or controlled. Climate change makes the stakes even higher. With rising global temperatures, storms are more intense, floods more frequent, and fires more destructive. The very foundation of the cat bond market, rare but severe events, is being shaken by a new reality where disasters are becoming less rare. How do you price the unthinkable when the unthinkable is becoming normal? The ethical dilemma. Profiting from pain? There's another layer to this market, ethics. Can you really profit from catastrophe? Should investors be making money by betting on whether people's homes are destroyed or lives appended? Critics argue that cat bonds turn human suffering into a financial game. Supporters counter that these instruments actually help societies recover by providing insurance companies with the capital they desperately need after disasters. Without catastrophe bonds, some regions might struggle to rebuild. With them, at least there is a safety net funded not just by governments, but by investors willing to take the risk. So are you exploiting disaster or helping communities survive it? The answer may depend on where you stand. The future of insurance-linked securities. So where does this strange market go from here? As climate change intensifies, insurance companies face risks so large they cannot handle them alone. That means more risk will be transferred into capital markets, expanding the insurance-linked securities universe. We are already seeing innovation. Bonds tied not only to hurricanes and earthquakes, but also to pandemics, cyber attacks, and even extreme mortality events. The frontier is expanding beyond natural disasters into almost any risk society faces. Imagine a world where investors are trading securities tied to droughts in Africa, floods in Asia, or global cyber attacks. That world is not far off. Are we building financial resilience or simply gambling with humanity's greatest risks? What this means for you. So should you, an individual investor, consider diving into this world? It depends on your appetite for risk. If you crave high yields, diversification, are willing to stomach the possibility of heavy losses in rare but severe events, catastrophe bonds can be appealing. But this is not a safe haven. It is a high-wire act. One wrong step, one freak event, and your investment could vanish. In this market, you are literally betting against nature, and nature always has the final say. Insurance-linked securities are one of the most unusual financial inventions of our time. They take the chaos of nature and transform it into a tradable asset. They offer investors a chance to profit where others see only destruction. London, New York, Bermuda, and Zurich are already building platforms for this market, and billions are pouring in. But the question remains, can you really invest in catastrophes, or are you playing with forces too big to control? The answer may depend not just on your wallet, but on your view of risk, ethics, and the future itself. Because here's the suspenseful reality. In a world where disasters are growing, catastrophe investing might either be the smartest play of the century or the most dangerous. If this video opened your eyes to the strange world of catastrophe investing, don't stop here. Like, share, and subscribe right now, because in our next video, we'll reveal the top 10 companies that will increase dividends in 2026. Believe me, you won't want to miss it.